So we're back in the lab with my good friend Kady Smith. All right,
Hello.
so just to give you a little bit of background on the lab, the reason why I was doing this was actually really for my kids, believe it or not. Being in the industry for as long as I've been in investments in real estate and all the things I come across, I found that it was so invaluable that I can leave information for like the next generation, right? And I've seen all these different podcasts with people talking about all these random things, right? And a lot of them are really like newer agents in that newer generation that's kind of doing a lot of this stuff. But in the reality, closing thousands of transactions, all the things that I kind of take for granted, and all the people I come across that have been very successful in what they do. And it's great to be able to get some of the really deep insights. So as they do investments, transactions, things like that, that they actually have some of the real building blocks in order to make things happen. So it gets a little technical at times, which is totally fine. But that's really the basics of the lab. So anyhow, to get your story kind of going and kind of doing my introduction with Kady here. So Kady with Goosehead Insurance, the Ocean Insurance, and specializing in residential real estate, specifically with insurance. Does a little bit of everything else with insurance, but insurance isn't necessarily one of those sexy businesses that we kind of talk about.
Oh, no.
However, things are changing. Fires,
Hurricanes,
policies, and things that people are not even thinking about, because they're all about trying to find their next investment property, or building ADUs is another big thing, or multi-unit investment types of things. But one of the areas that will really screw some people up is some of the technicality, like the insurance piece. Because I know when I do my flips or when I've done development projects, you just can't go in there assuming with a traditional hazard policy. You have to have something special because, and I've been in this situation before, I hate to say it, you have like uninsured contractors that go in there. So speak on that a little bit. So what are some of the differences now that you've been in the dark side working with all this realtors and lenders and the things that you do? What are some of the different types of things that you've been seeing in terms of how does someone protect themselves for those bad situations?
The investment property specifically?
Sure. Like like as a flip as an example, it's not like your typical hazard insurance. What kind of policy needs to be in place for that?
So you would need to find a company that accepts renovations, right? Because you're renovating the property and they want to know what kind of renovations are you doing. Are you adding square footage to the property? Are you tearing down any load-bearing walls? Are you just doing purely cosmetic interior? They want to know those things. They know what kind of risk it's going to be and if they can take it. And if so, how much, what kind of rate we'll be charging for that.
Yeah.
And with that, the policy itself is pretty simple. You're looking at, how much does it cost to replace the building as is? And then you're looking at what's the renovation budget. You add those together and that's typically the coverage you're looking at. Also on top of that, liability. So if anyone's injured on the property, if any property's damaged on the property that's someone else's, making sure you have coverage for that. However, that doesn't necessarily apply to the contractors. You want the contractors to be licensed, to be insured, to have workers' comp, because if anything was going to happen to the contractor, any of the employees during that time, you want to make sure that the contractor has that coverage in order to take care of that, because that likely will not be covered under the homeowner's insurance. So it's always important to make sure that you're working with a licensed, insured, bonded contractor. And
because if you're not, what happens?
You have to pay all of that out of pocket. They could sue you, or,
You will have to pay that out of pocket. I actually have a client right now, and I was trying to have her work with you, and super annoying that she didn't, because obviously you know what happened. So no names be named, but we have a client that recently closed on a transaction, and normally on the lending side, we try to provide the insurance company with a copy of the appraisals, copies of prelims, things like that, because it's just kind of courtesy business courtesy. It's not necessarily a thing that is always done. We just do it because we're like, hey, here's some information that can kind of help you as you guys put your policy together. When we don't work in cohesiveness like that, if it's like an outside agency, then it's really up to them to do the due diligence. So in this particular property, looked kind of like a condo, right? Just from the looks of it, had a master policy. In reality, it was a single family residence with a common wall agreement, which is typically not typical, but it's still a single family residence. Now, why is that important to know? Because the master policy for the HOA didn't cover the walls and the structure of the building. Well, as soon as she moved in, the AC unit got backlogged and it flooded. And she had a lot of personal stuff in there. And she was kind of a high net worth individual with some paintings and whatnot. Anyhow, her policy, instead of getting, HO3, which would be the single family residence, was inadvertently given an HO6 policy. HO6 policy is typically for condos. So now she's fighting with her insurance company. But to me, I would think and assume that normally as an agent that they would do their due diligence to look up the property description, the legal description, or ask for a copy of the appraisal because that's where it would have shown like the legal description, and looked at the master policy of the condo project or the HOA project, right? Because many times just the master only covers common areas, right? And sometimes if it is a condo, it'll cover the studs out, right? But in this case, since she got a condo policy, what would happen?
Okay, I love talking about condo insurance. So,
right?
Condo insurance. So if you're buying a unit, it obviously depends. The coverage you need depends on what the HOA covers. So if you're looking at their master policy, they can cover nothing, maybe just the common area, not even the buildings or the structures. They can cover the structures up to the bare walls, as you mentioned. Then you need a walls-in policy, which is, flooring, cabinets, counters, bathrooms, things like that.
And the walls-in would be typically that HO6?
Yes.
Got it. Okay.
So, and then there's some condo insurance where the HOA covers even the interior.
Yeah, but that's only like basic coverage though, right? Like if I upgraded it and put like Indonesian monk cabinets and quartz countertops and
sometimes they have that written in. So it's called betterments and improvements. So you have, no building coverage whatsoever. That's all in the homeowners, which you would get in HO3, which is a single family policy. It's the coverage you need, but there is going to be extra items on there that you might not necessarily need. But it is required and you'll need that, for the property. Then there's the bare walls, and the next three options I talk about will all require an HO6 policy, which is walls in. The bare walls, you're covering everything inside of that unit. Then they cover walls in. So they cover the interior for the condition it was in when the home was built initially. So if it was originally an older tile, older flooring, then they also, some HOAs, it's rare, but I've seen it, they cover the walls in and what's called betterments and improvements.
Yeah, which is rare though.
It's rare, but I've seen it a handful of times.
Yeah, because if your property is built like in 1970 with linoleum and formica, it may only have coverage for just that.
And I always advise it might be better to consider, and I had a client I helped earlier this week that we talked about, I looked over his HOA, they had enough coverage. He's a cash buyer too. So I was like, thank you for actually caring and looking into this because, you want to make sure you have decent coverage. Yeah. Especially if you're a cash buyer because, there's no lender to help advise you with that either, connect you with insurance rep, whatever it may be. Yeah. But they had walls in coverage without the betterments and improvements. So it was built in the 1990s or something like that. But we decided to do the full replacement costs that I ran for the unit and just insure it for that value just to be safe in case anything were to happen, that he has that full coverage for interior, and you can do that. But it's very important to look at your HOA master insurance policy because that really determines what kind of coverage you should be getting. And and a lot of times you're looking at the price when you're looking at coverage and shopping policy. So it's really important to make sure that you're actually educated on what the coverage is, what's your responsibility, what's the HOA's responsibility, and speaking with a representative that can help you figure that out.
And that's really, really, really important. I think that's one of the best things that kind of separates an agent like yourself versus calling like those 1-800 numbers where you're just getting a random person that's not really in the trenches. I mean, same thing happens in the lending side. If you're calling like customer service trying to do your loan versus an actual consultant that walks you through that process, it can be night and day difference. And I know that's why I love working with you in particular, because I value that. It's really important, especially for my clients. I really, really value that exactly in situations like this one. And also with not just the proper coverage, but I think sometimes too, it's just breaking down the lingo. Because, HO3,
what's
HO6,
coverage A?
what's coverage, yeah. And what's my deductibles and what's the lender going to allow and whatnot. And it sounds maybe a little bit more bureaucratic sometimes, but I feel like, just like your client with paying cash, it is too convenient. And so when you're online and you're just filling in the blanks and you're looking for the cheapest policy, you don't necessarily know. You may be shooting yourself in the foot just because you saved $1 or $2. And that's not, I don't like this instant gratification kind of world we're living in today, because I feel like it devalues in what we do. And at the same time, they're not getting the right protection mechanisms. Should they be able to talk to someone like you, then they would get that, So I feel like that's one of the things that's so important in especially working with a good agent. But I've also seen it happen for the best of us. I had an underwriter, been in the business a long time, had a condo. Mind you, she reviews transactions every single day. Her condo got flooded. And in her particular policy, the flood coverage or the water damage was only for natural disaster. And it wasn't for plumbing issues or man-made, they called it. So she had to come out of pocket. I forget the amount, but it was a pretty significant. It was like $13,000-$15,000, because not only did she have to pay for her place to get fixed, she had to pay for downstairs to get fixed too. And people don't think about that, especially for condos.
Yeah, and talking about flood, typically it's considered water damage under the homeowner's insurance. So flood, like natural disasters, is a separate policy. So I wonder if she had that separate policy for flood insurance or had it added onto her policy. But then if you're looking at water damage, which is like, you're looking at what caused the water damage. Was it a leak? Did a pipe burst? Different things like that. And the claims adjuster in that case would evaluate the situation to determine if it's something that's covered or not. And in the current market, with options being more limited, with rates going up, you'll see more options that look like it's a great rate, but there will be limited water damage. So any damage caused by water within the unit, within the home, might be limited. And I've been seeing that a lot more. And every time I see it and it's the best option, I'm like, hey, there's 2 options. This one, much better rate, but there's significantly less coverage when it comes to damage caused by any water in the home. Versus this option, it's a bit more expensive, but you do have that full coverage that you would typically have. So, yeah, it's important to make sure you have decent coverage there, because I would say water claims are one of the biggest items. And also specifically water backup and sewer sump overflow discharge is a separate add-on.
I didn't even know there was that. Crazy that you mentioned that. I had a condo. It was on the waterfront over in Crown Point. Literally my backyard used to get to the water. Like my backyard was on the water. And it was a condo, nobody in front. And we had some really bad storms this one year. And during the storms, there was a 2x4 that got like lodged into the sewer line. So then in my particular building, it's 4 units, 2 downstairs, 2 upstairs. And they were kind of 4, laid out kind of units. So our 4 units specifically got backed up with our sewer lines. And they had to come out and in the parking space trench down like 15 feet just to dig out this like 3-foot piece of 2x4. Luckily, it was outside of our units, and so the HOA was responsible for that. That was okay. Next door in the next building, my friend lived over there, and a couple girls in their unit, somebody, I don't know what happened, but they must have flushed a feminine product, and it stopped their whole unit. But because it was inside the building, they had to pay for it. It fell on them for whatever reason. I don't think the insurance covered it. And so it's funny that you mentioned that. We got really lucky.
And that's something that's not included. You always have to add that on. So I quote that for every single client at the maximum coverage I can have for that. And it's even something you can add on a renter's policy.
But I hate it, though, the fact that it's like one of those little things you have to click the asterisks. Like when you're shopping, if you don't click the asterisks and read all that fine print, which the majority of us, quite honestly, never do.
Especially insurance.
Oh my God, especially insurance, right? Mm-hmm. But that's really why it's so important. I mean, that's everything. And you may not think about it. And what are you saving? 20, 30, 50 bucks, maybe?
Yeah. Yeah, it's typically, I mean, depending, like a single family home, maybe it could be up to $100 a year.
Right.
Not too crazy.
But it makes total sense.
Saving thousands in the event of an actual situation happening. Also, you hear about that happening all the time, is water backing up through the sewer and the drains. That's very common. So it's definitely one of those items that's worth endorsing onto your policy to make sure you have that coverage.
Yeah.
And also, you know, you're not supposed to be an insurance expert. That's why you talk to someone who actually knows what's included and what's not included and having that conversation. It's worth the 10, 15, 20-minute phone call to actually get all your questions answered to make sure, you know, that you have good coverage.
And I know it's not like the most sexy, like I said, it's not the most sexiest of topics, but those of us that have been in the business a long time, that have gone through the experience and the pain of all these things, that's one of the biggest reasons why I literally cringe when someone's like, hey, yeah, I got, you know, USA, BCDF. I'm not going to mention any specific companies because, yeah, they do provide a good level of service and their pricing's inexpensive for the most part. But it's the fine print in these little technical things that make the biggest difference. And now, even with this whole fire thing going on, and especially the fact that we have all these different insurance carriers in California, leaving California, it's making things like completely different now. Expand upon that.
I do want to touch on that before. I think something important to note on insurance as well is insurance, they're going to cover whatever it costs to fix the damages caused by that loss. If you had a pipe burst in your home, they're going to help you pay for the items, you know, that were destroyed from that, but you're still responsible for the maintenance, which is repairing that item that caused the loss. So I think that's also important to note with insurance that, you know, they may consider certain things that cause accident to be maintenance, which that would be your out-of-pocket expense. Mm-hmm. So keeping that in mind when you're choosing your deductible, if you're choosing a higher deductible to save on your premium, also knowing there may be additional cost associated with a claim. And I wanted to touch on that really quickly because that's important to know. And then, the market, fire,
dude,
earthquakes, hurricanes,
this is
flooding.
like, it's so hard.
Hard market.
Well, I mean, you know, we already got interest rates going up, so making payments are already more expensive. But now with all these, number one, lack of the number of agencies they were able to shop from, the bigger ones, the Geico, was it State Farm, Allstate, they're pulling out of California. Well, who else has pulled out of California?
I know Berkshire's non-renewing clients in California.
Wow. Okay. So now you have less options to choose from. But compounded on that, because of the fires, now, and by the way, not just because of the fires, not even with a specific geographic location, because every insurance company deems whether or not that property is in a fire area, right?
Yeah, so what I see on my end when I'm quoting is I plug in the address information and they run through their system. They all have slightly different rating systems, but they're pulling in certain rates that if it's this rate or higher, that's, you know, it's not just, you know, the location. It's also dependent on the fire department, the local fire department that responds to that location.
I didn't know that.
It's about the response from.
So if you're in a community, let's say it's a unincorporated area, but there's people there. What would be something?
Also, like items like how understaffed a fire station is. So
yeah, I was just thinking like South Bay, like San Ysidro. There's plenty of new housing, but there's like they borrow a fire station from like a Chula Vista or somewhere close by, but it's not like in that immediate vicinity.
That could have an effect when I see the more populated areas in San Diego, usually the biggest issue I see is the brush.
The brush.
If there's a big chunk of brush right up against the home.
Like the green belt kind of areas?
Mm-hmm. That can have an effect more so when I'm looking at more city areas.
So a lot of times people they just assume the fact for fire that it's like an unincorporated areas, but you can be within the city and city limits, but just because you're on one of those particular neighborhoods that has, those green belts that go around the back of the house, or houses kind of with views, they're up on the bluff,
on a cliff.
On a cliff, yeah. But those are considered high fire areas as well.
It could be. It really depends. It's usually best just to plug it into the system, because one company may be saying it's fine, I'll insure it, I'll do fire, I'll do everything. Another company will say, nope, we're going to do everything but fire, essentially. And when it comes to those companies that if they deem a home to be a high fire area, they'll either deny the risk or they'll insure it and exclude a few items. Those items would be things like fire and lightning. We won't cover any losses caused by that. Wind and hail, vehicles and aircraft, smoke damage, items like that will be excluded from the standard insurance that we're shopping around with. And then we require you to get a companion policy with the California Fair Plan, which is a state-run program offering that fire coverage for homeowners that can't get it elsewhere. And they offer coverages for the fire and lightning, wind, hail, vehicles, aircraft, etc.
Now, let me ask you a quick question on that. So on the California Fair Plan, because that's typically what we've been seeing a lot of, does that cost vary insurance company to insurance company, or is everybody just going to the same pot?
Everyone's going to the same product, yeah.
So they're not even getting any benefit by trying to go like on their own, because it's not anything cheaper. You're just going through the state fund.
Yeah, and it doesn't cost you anything depending, some agencies may charge fees, but I don't charge any fees, so you literally just have extra support, someone to go through the whole process for you.
Yeah.
It's a lengthy process, probably turnaround time if everyone's on it, a week from getting recent photos of the property, sending that into the Fair Plan with an application, them reviewing it, returning back a quote, collecting a down payment up front to even get the policy documents, and another business day for that. So
that's good to know, because our transactions, even like right now, a lot of them are very short. Like we're getting 14, 21-day transactions. So if they're waiting to the middle or towards the end of the process to start shopping, and it happens to be in one of those areas, it can slow the process down big time.
Yep.
Wow.
And I think not only due to seeing a property that you wouldn't expect to be in fire, and then all of a sudden every company is saying nope, we need the Fair Plan to help us out with this. The process for that, obviously takes some time, but even if it wasn't a high fire area, other risks like the property and the previous owners having claims, a year ago used to not be an issue. I had some companies that cared, most did not, but now I have them saying, oh, we'll need a new inspection report to review. It'll take 2 to 3 weeks for underwriting to review everything.
Oh my God,
So just insurance in general is taking longer. It takes me hours to quote something that used to take me 30 minutes before a year ago. So having that insurance conversation right when you open escrow, because the last thing you want to do is get to your last day of loan contingency and realizing, insurance is going to be $5,000 a year, and that doesn't work with your DTI for the loan. So
because that can break a deal if they have a very expensive policy. I've seen that happen. Yeah, that's so important. I can't even tell you how critical it is to make sure that just that upfront communication is happening early on in the process. Because if we don't have a good dollar figure on that insurance policy, and we're estimating $150 a month in payment, and then it comes in at $350, it can blow a deal up all day, and that jeopardizes ultimately the buyer's initial earnest money deposit. So and I've been seeing this happen regularly. The other thing I've been seeing happening too, though, is like in condos, the master policy not having that fire coverage. That's another one that people are not anticipating, because if they don't have proper replacement cost coverage, especially with all this inflation that we've been happening, as a lender, it's now going to fall under a like non-warrantable condo, or we can't do traditional financing. It's going to kill us on Fannie Mae, Freddie Mac, FHA loans.
And then if you're trying to sell a condo, you can only sell it to cash buyers. But then what cash buyer is going to want to buy a condo that you can't resell as easily?
So if anybody's watching and you do have a condo, I would highly suggest contacting the board members on the HOA to start questioning their coverages on that project, because if they don't do it early on in the process and it starts to become an issue with lenders, it can affect long-term property values.
And I would say, honestly, the biggest issue is probably having some building coverage and saying you cover all of the building, but not having enough coverage. It's almost better to not have any coverage. Let the homeowners have an HO3, which is a single family home policy, which maybe it's a little excessive, but everyone would have that proper coverage for the structure to share in that cost.
That's a really good point. That's actually a really good solution too, because if they did do that, it would help keep the HOA dues at least a bit cheaper. But it does depend on the project, because if you have like a 6-story building or something and you're in one of those kind of units, it's different. But if it's, single story, townhome style, twin home style, then it's okay. I can see how that would work. And it would keep your policy cheaper. You know what I mean? That's just a thought.
Yeah, and I think just HOAs, their insurance rates are going up just as much as, homeowners. So the reason you're seeing a lot more limited coverage in these HOA insurance policies is because they can't afford it. Yeah. They're bumping up their deductibles, they're lowering coverage, and it's still so much higher than it was before. Or they're getting non-renewed and they can't find new options. It's just as hard for them to reshop as it is for us, specifically in the high fire. I see it mostly in the high fire risk areas for condos.
And if those boards are not on the ball with understanding some of these concepts or the situation that they're currently in, then they will find themselves in a situation where those properties can't get particular types of financing on it. That will affect, because you're just taking out the buyer pool is essentially what you're doing. You figure 80% of all purchases are typically owner occupied, right? That's just, it is what it is. Condos especially are predominantly entry-level purchases. They can either be downsizing, but predominantly those types of loan types require full condo reviews. So now the lender's scrutinizing that condo because, well, the buyer's putting less than 10% down, or, for whatever reason, they have to get a full review. But once they start doing that full review, and if they don't have proper coverage, then we can't do financing on it. You're stuck. We had one like that situation where the condo project had not yet finalized the renovations to the balconies. So I guess a couple years ago, there was some regulation in California. They changed the balcony,
like 4 feet or
whatever strapping reinforcement that they had to do, whatever reinforcement they had to do on some balconies. And it was like, I don't know, $3.5 million. And when I looked that up, I was like, man, that actually happened a couple years ago. But this HOA was just barely getting around to doing it. And I was really surprised because the price point was pretty cheap. Everybody's happy, like, oh my God, it's so cheap. We looked up the transaction history in that project for the last 6 months. Over half of them were all cash. And I'm like, well, okay, this makes a lot of sense now because nobody's giving this property loans. There's a reason why it's so cheap in this specific area, was because the HOA wasn't keeping up with all the expenses associated to that project. And so it may save you money in your HOA dues, but in reality, your property value is going to get affected in the long run. God forbid they have a major event.
And who's to say they don't bump up their HOA fees to help pay for those?
Well, each homeowner got assessed $9,500 in a special assessment fee.
Ooh, something else to talk about. You can get coverage on your homeowner's insurance for that.
Really?
Depending. So let's say, a special assessment, that's what the HOA charges the homeowners of the condo units to share in whatever major expense they have coming on. If the roof needs maintenance, the roof's old, it's over 30 years, needs to be replaced, that's not something that's maintenance, right? Wear and tear maintenance, that's not covered under homeowner's insurance. But if there were a major fire and now there's all these damages to the building, the structure, they need to have the homeowners share in that expense, then you can have what's called loss assessment coverage on your homeowner's insurance. Usually $1,000 is built into most policies, especially owner occupied. You can bump that up. It's pretty inexpensive. If there's an HOA, I start with at least $10,000, and I let them tell me if they want to lower it or remove it. I'm always transparent, adding on, the water backup we talked about, the loss assessment. I'll add these in. I'd rather have that coverage available, worked into the price, and you tell me to take it off, knock it off. I'll just pay it out of pocket. I don't care. I started at least 10,000, but I that one assessment was 9,500. It doesn't hurt to just bump it up to maybe 50,000, looking at what the price difference is and seeing if it makes sense.
So far this year, we've seen at least 3 transactions where the condos had special assessments. Yeah, just because they were falling short. And this really is reminiscent of like 2006, 2007 market conditions, only because, back then when we started having foreclosures and people not paying payments into their HOA dues, we started having issues in condo projects because they just didn't have enough money in reserves. But that was the whole process. It was the whole problem was not having enough reserves. So they'd start suing the developer to try to get back to them to reclaw back some of the repair costs that they now have to pay. But that was due to non-payment of the HOAs. Now, because of the cost of inflation, because of the cost of things like insurance going up and all these different coverages that they need to have, I personally foresee that the reserves are going to start getting hit. And if they start having to assess each of the homeowners, because that would suck to have a condo and find out that they don't have enough money to repair a roof and you got a hurricane coming and now it just compounds the issue. You're like, yep.
Yeah, that would suck.
It would suck. I've been there. I had bought a condo, like I said, the one in Crown Point. We started off at $350, and because there were so many foreclosures in this particular project, I want to say like in a year and a half, it was bumped up to $550.
When did you buy that property?
I originally purchased it in 2004, and it was before the foreclosure started really hitting. A developer, it used to be I was going to call it like a leisure place, but it was I forget, like not like a resort, but I forget what it was. It was really normally like regular apartments. So they did a condo conversion. But in that process of doing the condo conversion, the developer fell short. And so they couldn't finish all these villas on the front of this project. So they went to all foreclosure. And all the villas went foreclosure at the same time. So when my friend, Seth O'Byrne, dude, you hooked me up. We flipped coins on which unit we were going to get. I kid you not. So me, my buddies, we all were like, I want that one. I want that one. No, I want that one. Let's flip a coin for it. And we literally flipped coins in front of the project.
So you each bought one of the 4 units?
Yeah. There was 1, 2, 3, 4, 5, 6. Each of us bought one of 6 on these villas.
So you all lived in the same building?
Yeah.
That's pretty cool.
Yeah. One of my friends was my neighbor 3 times.
Oh, that's crazy.
Yeah. So I had a builder I was working with on a builder track. And I bought a specific home on this builder track. And he bought the one across the street. And then in the condos, same. And I bought one. I bought the downstairs one because I wanted the one with the patio because the water backed up to our backyard. And he wanted a balcony, and he ended up getting the next door building, 2nd story. And so he was my neighbor there. And then when we moved over to La Jolla, then he bought on the street, like, I don't know, 4 or 5 houses over. So he's been my neighbor 3 times.
You like him though, right?
He's a cool dude. He's all right. Annoying sometimes, but I can live with it.
He keeps coming over. I don't know why.
Yeah, he's just there. But yeah, and it's been probably for 15 years. We've just been random neighbors.
That's so fun.
It's super funny. But yeah, so anyhow, when we got that project, when we bought into that building, because it had so many foreclosures in it, they just didn't have enough money for the reserves. So once it finally got stabilized and all these investors, we started purchasing the properties in there, started redoing all the reassessments, and then, getting everything back up and running. And then, oh man, like after like maybe 2 years, we had a bunch of floods. I'm not sure if this was during the time of Hurricane Katrina or not.
Well, it sounds like this was within 10 years of...
Yeah, because FEMA had reassessed the
Flood zone.
the flood zones. And so then we got deemed into a flood zone because obviously the water backed up to my backyard. And then we had to get an additional flood insurance coverage. HOA had to cover that cost because it was part of the HOA. And then our HOAs went up again. So, yeah, it was getting pretty pricey. So I ended up selling it.
Yeah.
But hindsight, I really wish I would have kept it because it would have been such a dope place to keep as a retirement. But I would have had like a $700 a month HOA, you know.
It's like the cheapest HOA you can get downtown these days.
Really? Yeah. Yeah. But it's just weird though, because, you know, as we own property, as we own single family residences, we're not constantly going back and reassessing our insurance coverages. We're leaving it at the price that we bought it at, and we're not taking into consideration the cost of materials going up. And I've seen people where they fall short and it does go foreclosure. And when my friends will end up buying it, and I don't like that. That's not cool. And it's such an easy thing just to get your property reassessed and get proper coverage. So simple. It's such a simple concept.
And also right now, I mean, it's first off really important to just pay your insurance on time because the last thing you want to deal with is a cancellation. Maybe they're planning to continue renewing you, but they can't offer a new policy to you or whatever it may be. It's so important to just pay your insurance on time, both auto and home and whatever, you know, policies you have. And it's also just as important to shop right now, I think, too. You know, a lot of people are forced to shop right now. They're getting non-renewed. Fire is a big issue, or maybe the company is just leaving the California market altogether. And it's either that or they're renewing you. Your rates are going up. So it's a good time to shop just to see what else is out there, reevaluate your coverage.
Yeah.
Because, you know, the reason why all these companies are leaving California is because the cost to settle claims is going up with cost of labor, cost of materials, inflation, and it's starting to get more expensive for the insurance companies. So,
you know, a question for you. Does it make more sense for, let's say, someone like myself, or let's say we have an investor out there that owns 5-6 properties? Does it make sense at a certain point for somebody just to get like an umbrella policy and just have them come, just do the umbrella instead of paying, you know, 5 separate policies?
Well, the umbrella, in California, you have to have each dwelling insured on its own policy.
Okay.
So even if it's an ADU, an additional dwelling unit in your backyard, if you rent it out and you occupy this residence, that's a separate dwelling now. You need separate insurance for that. Umbrella insurance is an extension of your liability coverage, not of your actual like building coverage, your personal property coverage.
Got it.
There are certain coverages most clients have. You can bump it up more. One's called the extended replacement cost coverage. Typically I always add it on at least 25%, sometimes 50%. Most clients I see have this. I'm usually shocked if I don't see it, which I have seen quotes they got from other companies that didn't include it. But let's say, to keep it simple, let's say the estimated cost to rebuild your home is $100,000. Just to keep it simple. It's obviously a lot more here.
Yeah.
But
let's say 300,000. Let's use 300,000. The house burns down.
300,000. You have a 25% extended replacement cost coverage built into your policy. That means you have an additional up to 75,000.
Yeah.
On top of your 300,000 towards rebuild costs. Should it cost more due to, 6 months from now it could cost more, labor and materials that's going up.
Yeah.
If there's a catastrophic loss, the whole neighborhood is burned down or whatever it may be, it may be even more expensive to rebuild. And then you can have 50% here. So you have another 150,000 towards rebuild costs. There's also ordinance or law coverage that typically you see included for at least 10%. Usually you have an option to bump that up, and that's increased costs due to building code related reasons. The home was built in 2000. It's not that long ago, but now homes are required to have sprinkler systems
and
installed.
solar.
And oh, really? I didn't know that.
Yeah.
New construction.
Yeah, any new construction solar now. Yeah.
Okay, that's good.
California sucks. Yeah.
So that's an additional cost that's not calculated. We're calculating what's the estimated cost to rebuild your home in a similar condition, similar construction materials, but then you take into account building code. You're going to have to build it up to modern building day code, and that's going to cost you more. So having that built into your policy as well.
On our construction side, we had situations come up, like in Oceanside, certain parts that because of the location of proximity of the property, they had to have fire extinguisher system. What are they called? The
fire suppression.
Yeah, and that's pretty pricey. That's another $50,000-$60,000 of an add-on. Mm-hmm. So it can add up. And if you're not paying attention, that's why I say, if you're not paying attention to at least sitting down with you and kind of revisiting, you can miss something like that. Then you have a catastrophic event, and then you're going to fall short, and now you're going to have a problem. So, because it is pretty fresh, and I know what happened like in Hawaii recently with that type of fire, we hear a lot of reports that people are not getting their settlements covered. Like, how can something like that happen? Like, do they view catastrophic events like that different than a traditional house fire? I mean, why would they be so difficult when it's such an evident loss? There wasn't enough firefighters to do anything. So what happens in that case?
Well, I also am curious about Hawaii because I imagine it's a lot more expensive to reconstruct because you might have to ship in a lot of materials. So I imagine the claims time to get homes rebuilt is probably a lot longer as well.
That's right. So back to the original point, if you are trying to go 25% or 50%, but you got that policy 5, 7, 10 years ago, even that little extra bump of, it may not be way short.
A lot of companies build in like a 3% inflation guard. Every year we bump up your dwelling coverage 3% every year, whatever it may be, depending on the company. Mm-hmm. But we know inflation's a lot higher than 3% right now. So
just a little bit.
Just a little bit.
Just a little bit. I feel it.
Yeah.
Yeah. That's interesting. And especially like in those kind of neighborhoods, because that was a really established neighborhood for the most part. It was one of those tourist places. People took pride of businesses and all that kind of going on. So if they weren't keeping up with those things, then they were going to fall short.
And we're hearing of so many more natural disasters than we used to, right? The world's changing a bit. So.
But yes and no. I think that's a wake up call for people to just say, hey, this stuff just happens. I think we're more hypersensitive now because it's so sensationalized by the media, like our hurricane we're going to have, right? the end of San Diego, I swear to God, that felt like, the apocalypse was coming. But needless to say, though, because I did drive by Mission Bay and I was in those neighborhoods and I was really surprised. That's why my condo was right there on the water. And I told my wife, I was like, we're probably lucky we sold that sucker because if it rose another foot or 2 feet, it was going to be flooded straight up, done, and I wouldn't want to not have to deal with that, especially as a rental, because now I have to house my tenants and deal with all that. And that's just more stress.
And it's important if you're a landlord to have your tenants have their own insurance because their insurance can pay for those additional living expenses. You basically are losing out on your rent is what you're losing out on during that time. If they need to relocate while the repairs are being done, you can't really charge them rent during that time. And then they should have coverage built into their policy to help with any additional living expenses they're acquiring on top of what their normal would have been before the loss.
Yeah. Now, there is rent loss coverage though, right?
Mm-hmm. As called an option?
Loss of rents. But that only covers you for fair market.
It depends on each company, I would say.
Okay.
Because also, like if you look at Airbnbs, you could look at the past few months or whatever it may be, the past history of the nightly rentals and things like that and try to get more for that for what would make sense. So it really depends on every company and claims adjuster. It's very much, when we're talking about specific situations for claims, it's a big gray area. It all depends.
So really bottom line at the end of the day, as your situation changes, it's not just a matter of going online, doing a couple of changes. They should really sit down and look at all angles of coverage because it's only a couple $100 difference maybe sometimes, but the benefit, should something happen, way outweighs the risk.
And it's so important that if you decide to move out of your property, turn into a rental, you need to restructure your insurance. If there's a claim, you never changed your insurance, and they find out there's a tenant living there, they will likely deny the claim, cancel your insurance. Now you have to find a new policy that's properly written to insure a tenant-occupied home.
Wow. I didn't know that.
Yeah, they're different. They're DP3.
DP3.
So HO3 is owner occupied.
Is that like one of those things like when you have like car insurance where uninsured motorist? So like if you're driving your car and you get in an accident, that's one thing. But if you lend your car out to somebody else and you don't have like uninsured motorist coverage because you lent your car out, then you're toast.
That's like permissive use.
Is it?
So I have some companies that get particular where if there's anyone living in the household, they want to know that on the policy. You can exclude them as a driver. But since they're a member of the household, they have regular access to the vehicle. If they are going to drive the vehicle at all and have that permissive use coverage, they need to be listed. That's one of my company's requirements. Or if they don't drive it at all, but they live in the property, you can list them on there, exclude them as a driver. They're not a driver. And then, you don't want them driving your car because if something happens, you don't have coverage. But typically permissive use, depending on each company, if you're loaning someone your car for over a month, that might be an issue. But if your friend borrows your car to go to the grocery store, grab something.
I swear to God, this is why I wanted to have you on, because it feels like I'm playing a mental game of chess. Like it's like lending, you know what I mean? There's so many different angles and so many different facets to think about that unless you're in the game and unless you're like, you understand the lingo, the language and all the maneuvers, as a consumer trying to do it on your own, it's not worth it. It's not worth it. On the lending side, because we have so many different product types, how people get paid, methods of pay, all these different things, it's hard enough for us to continuously stay on top of all these regulations and changes, let alone the consumer trying to step in and saying, hey, I got this. And the systems make it so convenient where you just fill in your name and your last name and your email address and your phone number. And you're like, wow, that sounds great. Pow. When I was doing my insurance coverage, I did do my renewal with Progressive the other day. I actually had to have you check it out. But I went through it, added another vehicle on. And I was like, man, I literally sat there because you saw when my last accident, my fancy Mustang. And I was stressing because I was like,
what happened with that?
Dude, that paint job is
on your car or the Tesla?
On my car is $25,000. Yeah, because it's a full restoration. Did
you get that covered?
It's covered.
Policy? Did you get the video footage from the Tesla showing it roll down?
No, they didn't have that feature turned on. Yeah, so for those of you who don't know, I actually have a 65 Mustang Fastback Shelby. And it popped out of gear on my driveway, rolled down, rolled over the street, and backed into my neighbor's brand new Tesla. By the way, so his Tesla, this is what's even funnier, because I met the adjuster. The adjuster that came to visit him was the same adjuster that visited mine, and they use a third-party adjuster. Initially, just from basic looks, had a technician look at it, they were thinking like $2,500. When they really got into it, because of the labor and it did do a little damage of dent, it came out to $14,000, that repair for him, just on his side. Then on my side, it doesn't look bad. Like it doesn't look bad. It shifted a couple little spaces where you can see like a warp, and not like a ton of labor for the handcrafting piece of things, but because of the type of paint, but because there's the way the car is laid out, where there's no brake lines where they can kind of like stop at certain areas, or like, well, we got paint all over this. And I was like, you're kidding me. And he's like, yeah, that's just what we have to do. And because I have Haggerty, opens up the trunk, and obviously there's a different paint color underneath the trunk because it is a full restoration. And yeah, he's like, and from my initial estimate, the guy quoted me like $9,500, right? That was my first. And he's like, oh, no. That's like 12, 15. I'm like, dude, just for this? Yeah. So, but I only had a $500 deductible, which was freaking awesome. We're not done yet. We're still going through the process.
How's the process been so far?
Slow going. Slow. Yeah. I've been reaching out and just trying to get the customer service to get me on the phone. Then they send the guy out, took a ton of photos and everything, and just verify all the information, whatnot. But it was good having the adjuster out there just to talk to them and kind of get an idea. Luckily, I ran to your office and I was like, help me, please.
Help me.
I was going to pay out of pocket. I was just ready to pay out of pocket. I really was. And hindsight, that would have been a $40,000 out of pocket instead of $500. So
yeah, worth it.
It was worth it.
And I think that's a big thing with insurance is you need it. You're required to have it.
Yeah.
But, balancing, is it worth having the claim? How much is it going to cost? Should I just pay it out of pocket, not worry about, because claims stay on your record, right? Or, if it's going to be, $40,000.
Or medical. I'm lucky.
Yeah, if there's any medical.
At that time when that happened, it was 8:00 in the morning. I'm getting my kids ready for school.
Someone could have been biking down.
Their kids were getting ready they have little kids too. And there was no way, it was in such a slow motion kind of situation. I turned around and I'm like, where'd my car go? And we literally watched it in slow motion happen. And it could have been worse. And luckily I have wonderful neighbors. We're good friends. We were all there just watching this slow motion thing happen. It was so hilarious. It's so sad. Just the way I can just imagine what a video camera would have looked like. Me standing in the street with my hands in the air, just screaming my head off.
It's it's raining outside. You're up on the window. Just
no, I'm telling you, I started running down the driveway, and I literally was I watched it happen, and it just like a little and as it hit, I was all no. Oh, and then she came across the street, gave me a hug, and she's like, hey, no, nobody got hurt. It's okay. I'm like, my child.
It's your child.
Yeah, so it was good. So thank you so much for sharing all that information on insurance. I think for me, bottom line, keep it simple. Sit down with someone like yourself, sit down with you, and really go over all those individual intricate options that as a consumer, we would so easily overlook. Mm-hmm. So thank you.
Yeah, my pleasure. Thanks for having me.
Back at the lab. See you guys in the next one.